Hello everyone, this is Layla Shaver with My RA Lawyer. Everyone is in Q&A mode, which means you just have to select *6 in order to raise your hand and ask a question. And then your question will be answered as you ask. Otherwise, we'll have the Q&A at the end of the presentation. So this week we are talking about the anti-fraud rules, the code of ethics, and then how to communicate this with your clients. So Section 206 of the Investment Advisors Act is the section that deals with the anti-fraud rules and applies to all firms and persons meeting the definition of the investment advisor, whether or not they're registered with the SEC, a state securities authority, or not at all, meaning they fall under some sort of exemption from registration. Section 206 prohibits material, facts, and other fraudulent acts and practices in connection with the conduct of an investment advisory business. It also gives the SEC rulemaking authority to define the acts, practices, and course of business that are fraudulent, deceptive, or manipulative, and to establish rules reasonably defined to prevent fraud. So Rule 206-4-1 applies to advertising, -2 applies to custody and possession of client funds or securities, -3 applies to payment of fees by advisors to third parties, so generally we know those as solicitors. And then -4 applies to financial and disciplinary backgrounds. Now we'll be talking about the first three in the upcoming weeks, so custody in week 10, advertising in week 11, and fees to solicitors in week 12. But what we are going to talk about today are financial and disciplinary backgrounds for investment advisors. Keep in mind that examiners are likely to review registered advisors' practices regarding their disclosures of regulatory, disciplinary, and other actions with a focus on assessing the accuracy, the adequacy, and the effectiveness of those disclosures. So let's start with the definition of a supervised person. A supervised person is any partner, officer, director, or someone that occupies a similar function, or an employee of an investment advisor, or someone else who provides investment advice on behalf of the advisor and is subject to the supervision and control of the investment advisor. So all of your IARs are going to fall under this category. Keeping in mind that as a fiduciary, you have the duty to make a full and fair disclosure of all material facts, including all material conflicts of interest that could affect the advisory relationship. So we define supervised person because these are the people that we're going to have to make disclosures about to our clients. So let's talk about disciplinary and financial information. So we are going to discuss the brochure in more detail on a different webinar, but I wanted to pull out the various items that discuss compensation, so financial, any sort of conflicts of interest. So when you're looking at item 5 and 6, you're discussing the standard fees that the firm receives. Item 9 goes into the disciplinary information for the firm and the management. And then item 14 discusses other sources of revenue that clients may not consider. This especially comes up with duly registered advisors. So for those of you that are duly registered and are associated with a broker-dealer and RA, that's where item 14 is going to come up. Now, let's go back to item 9. When you're talking about disciplinary action or disciplinary information, we're going to be talking about legal events, any sort of disciplinary event that's occurred at the state or federal level in regards to a regulator. And these are different types of regulators, not just ones that deal with investment advisors. And the facts have to be material to a client's evaluation of your integrity as an advisor and the integrity of your management. Now, arbitration awards are not required to be disclosed in the brochure. And this, in item 9, you're going to be listing disciplinary events that are presumptively material if they occurred in the last 10 years. Now, you can rebut this presumption and not make the disclosure, but you have to document how you came to that determination, and then the record has to be retained in your files. So if an examiner comes in and they have a question about it, you're able to take out the memo or similar record that you put together explaining why you didn't make the disclosure, why you were able to rebut that presumption of materiality. And events more than 10 years old may or may not need to be disclosed. It just depends on the facts. Item 14, we were talking about duly registered folks. So you have to disclose compensation for client referrals or any other arrangement where the firm receives any economic benefit, including sales awards for prizes. And it can be from a person who's not a client, and it can be for providing services to clients. So this comes up, especially with duly registered folks, because a lot of broker-dealers are still providing bonuses or perks for people meeting certain revenue goals at the firm. So, for example, if you receive first-class tickets and a free hotel to a conference because you have met a certain revenue goal, then this needs to be disclosed. And this is for a member of management. And then beyond just prizes and awards, a loan from the broker-dealer or advisory firm to the supervised person is also considered compensation, whether or not that loan is forgivable and has to be disclosed. And then finally, item 18, this is where we disclose certain financial information that's material to clients. An advisor that requires prepayment of more than $1,200 in fees per client 6 or more months in advance must include in its brochure an audited balance sheet. An advisor who requires or solicits such prepayment or has discretionary authority or custody of client assets must disclose any financial condition that would likely impair its ability to meet contractual commitments to clients. This is really important if you're just starting out, you're a young RIA, so to speak, you're building your book of business. It's when you're disclosing any sort of financial condition, if you're having issues where you may be on the brink of filing bankruptcy or you have filed bankruptcy, you're having credit agency issues, you have to really consider what's going on personally in the management person or the owner's life that could impair the financial condition of the firm. And then you also want to consider the firm itself, whether it's having any credit issues, whether it's having trouble meeting payroll, or it's having trouble meeting its obligations, and whether any sort of litigation has been initiated. This is also important when we're talking about your net cap requirements as a state-registered RA. Some states require bonds, some require minimum net cap. And so if you are not able to keep up with the net capital requirement in your state, or you aren't solvent, you aren't maintaining a positive number on your balance sheet, these are situations where a regulator may find that there is an impairment that you need to disclose. We've actually have conducted mock examinations on clients that, their year-end balance sheet was negative, and that is a material event. That is, that's an issue that would need to be disclosed. So the next part of Form ADV is Part 2B, and this is basically the revenue, or not the revenue, but the resume for each investment advisor representative, and goes through their education, their employment history, and then also their disciplinary history, their financial history, and conflicts of interest. So item 3 is where we discuss the disciplinary information for the individual IAR. So anything material to a client's evaluation of the IAR's integrity. There's a list of disciplinary actions that are presumptively material. And again, we can rebut this presumption and not make the disclosure, but the determination has to be documented, and you have to maintain a record. So there may be some things that fall outside of that 10-year kind of timeline that may in fact still continue to be material, and you need to continue to disclose it. So you want to make sure that whatever decision you come to as a CCO, or whatever decision you come to in coordination with your consultant, that you are documenting if you're rebutting that presumption of materiality. With respect to disciplinary actions, so again, if you're duly registered or not, so if you have information on broker check, any disciplinary action while you're a broker, or on the IAPD system, which is for investment advisors, you can disclose in a brochure supplement that's delivered electronically that you have a disciplinary event, and then just provide a link to the right system, broker check or IAPD, to refer that client to a particular disclosure in your report that's publicly available. Now, it's probably easier just to discuss it versus having them go into the website, pull the report, and read what's been added, what your firm decided to add under that disclosure item. Item 4 goes over other business activities. This is other capacities in which the IAR participates in any investment-related business, information about their compensation, and again, discussing any bonuses or non-cash compensation. So, the first class ticket, free conference, free hotel stay, that kind of thing. And then any non-investment related business activities or occupations that would involve a substantial amount of time or pay. Item 5 goes through additional compensation, so any arrangements in which someone other than a client gives the supervised person additional compensation for providing advisory services. So I want to give you guys kind of a case study of what can happen. Now, granted, this is, a larger scope when it comes to an issue in disclosing compensation. So this is in the matter of Guggenheim Partners Investment Management, LLC. We had a senior Guggenheim executive. He got a loan from one of his clients, one of his advisory clients, and it was for a personal investment he made in Guggenheim's parent company. Now, the client who made the loan also invested, as did some other clients, but he was able to invest on more favorable terms than the other clients who also invested. And the Guggenheim executive to whom he made the loan played a role in structuring those different terms on the investments. Now, the SEC came in, they found that senior officials in the parent company knew of the loan. but didn't inform the compliance staff, didn't disclose the loan or the potential conflicts of interest to any of the other clients involved in the transactions. And so without admitting or denying, so this was obviously settled with the regulators, Guggenheim agreed to pay a $20 million penalty to be censured and to engage an independent compliance consultant who could have oversight and to also ensure that they had policies and procedures that would prevent this from happening in the future. So as fiduciaries, investment advisors must be vigilant about disclosing all material facts to their clients, including actual and potential conflicts of interest. And that's according to Andrew Zaresny, who is the Director of SEC Enforcement, and who was involved in the Guggenheim case. Now the next part, when we talk about anti-fraud rules, is the Code of Ethics. And the Code of Ethics is really important, A, because it's required under the Investment Advisors Act, Rule 204A-1, and also because state regulators require it as well. And you are required to discuss the Code of Ethics in your firm's brochure in Part 2A, and you have to make a full copy of the Code of Ethics available and present to your clients upon their request. So it's really important. It establishes the ethical guidelines of your firm, and it sets forth the standards of conduct and requires compliance with laws and reporting of personal securities, holdings, and transactions. And it's based on this principle that supervised persons owe a fiduciary duty to their clients and to avoid serving their own personal interests ahead of clients, taking inappropriate advantage of their position in the firm, and any actual or potential conflicts of interest or any abuse of their position of trust and responsibility. So it's a very high threshold. As I mentioned before, you're required to discuss it in your Form ADV and make a full copy of it available to your clients. So when it comes to the part about reporting of personal securities transactions, we're going to jump into this more in depth in a separate webinar. But keep in mind, this is the reporting of personal security holdings of your supervised person. So this is your management, this is your IARs, this is people dealing with making investment decisions for clients. Even your portfolio manager, they may not have direct access or direct communication with clients, but they're determining securities, they're doing research. These are the kinds of people that would be subject to the Code of Ethics and would have to provide reports of their personal securities holdings and transactions. This has to happen on at least a quarterly basis, and certain investments should require pre-approval. It's important to consider what restrictions you want to put in place for personal securities transactions as well. We've seen firms that only allow employees to trade through their firm, so they're not allowed to go to an outside advisory firm or brokerage firm and have a personal securities account. Others require that they maintain lists of prohibited securities, and they also have a list of pre-approval required securities. So they'll maintain one or more different types of lists so that their employees know when they have to get pre-approval and what securities are off limits. And those generally will get updated every quarter. There are other firms that will just say, you're not allowed to take a position that's adversarial to our clients. So the important part of all of this is to document what your standard is. What is your rule for your firm? And that goes into the Code of Ethics. And then you have to make sure you're monitoring it and enforcing it. And you're monitoring it by reviewing the personal securities holdings, by getting those duplicate brokerage statements, and then you're enforcing it by taking action if you see someone violating the standard that you've put forth. So again, we're going to discuss employee reporting and monitoring in more depth in week 8, but that's just a general overview of that piece. Each employee should receive a copy of the Code of Ethics and any amendments, and each must acknowledge in writing receipt of those copies. It's best practice to hold periodic orientation or training sessions with new and existing employees just to remind them of their obligations under the code. And it also reinforces the standards of the firm. So it's the responsibility of the CCO to maintain the Code of Ethics. The firm has to keep copies of it, records of any violations of the code, any actions taken as a result of the violations, and copies of its employees' written acknowledgement and of receipt of the code and any amendments to it. Advisors must also keep a record of the names of their access persons, the holdings and transaction reports made by access persons, and records of decisions approving access persons' acquisition securities and IPOs and limited offerings. So what the hell is an access person? Well, good question. It's any supervised person, which we defined before as your management, your IARs, director, etc., who has access to non-public information regarding any investment advisory client's purchase or sale of securities, or non-public information regarding the portfolio holdings of any reportable fund or any person who is involved in making securities recommendations to clients, or who has access to recommendations. So key part being you have access to non-public information regarding portfolio holdings, securities recommendations, purchase and sale of securities for clients. All directors, officers, partners, or IRs are presumed to be access persons, just to kind of simplify it. Now, the best part of the anti-fraud rules, having this fiduciary standard, having the code of ethics that you're required to have in place, spending all this time monitoring and enforcing it, is that you can actually use that to market your firm. You can use these standards, these high standards in which you're subject to really bring in clients and show them how you're different, or it could be the closing piece on a sales conversation to convince them to come on as a client. So Stephen Blum, professor at the Wharton School of Business, he once said, "A true professional uses his or her ability and power solely to advance the best and truest interests of the client. When the professional's interests diverge from those of the client, the professional follows only the client's interests." So I've given you some talking points when you're discussing the fiduciary standard with your clients and how that differs from the suitability standard that brokers are subject to. So the suitability standard being defined as determining whether or not a product or strategy is suitable for an investor based on their objectives and risk comfort level. So this is where your advisor is just determining whether a recommended product or strategy is suitable, whereas the fiduciary standard is a much higher level of responsibility and goes beyond just suitability and requires that any advice on products and strategies be in the best interests of the investor. You know, the suggestion being that just because it's suitable, it may not necessarily be in the best interest of the client. So this means that at the fiduciary standard of care, the advisor is taking into consideration whether the fees are reasonable, whether there are any conflicts of interest, and whether the investments are adequately diversified. Now, there's some issues that have come up when it comes to duly registered advisors, and there's been a debate on whether you need to identify as a duly registered person when you're acting as a broker subject to the suitability standard and when you are working as an investment advisor representative subject to the fiduciary standard. The best practice would be to maintain the fiduciary standard across transaction types. Mostly because those that we see that are duly registered, they tend to do more work on the RIA side than on the BD side. And it can cause confusion. And it could cause a disruption in the service you provide your client. And it could go so far as to sow some distrust and hesitation in your client if you're throwing all these different standards at them and trying to explain when you're working in one capacity or another. So in my opinion, stick with the fiduciary standard. It's best practice. It reduces confusion. And in the end, it's, you know, you're serving your client the best that way. So that is the end of our presentation on the anti-fraud rules, the code of ethics, and how to discuss the fiduciary standard to clients. We're going to turn off Q&A and go into roundtable. If you have any additional questions that didn't get addressed or anything comes up later when you go back and review the content of the video, please feel free to email us at compliance@myralawyer.com. We will be happy to answer your questions and clarify any points we made today and provide some more clarity as to how this pertains to your business and how it affects you. If you do not have a code of ethics and need one, definitely reach out to us because it's a requirement regardless of whether you're state or SEC registered. So you want to make sure you have one in place and you don't want a regulator trying to discipline you or fine you if they find that you don't have one in place. So thank you guys, and we look forward to speaking with you next week.